Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
Welcome to The Explainer. Today, we're going to break down a really massive shift in the U.S. tax world and what it actually means for businesses, whether you're big or small. All right, so let's just dive right in. A huge new federal tax law just dropped. People are calling it the One Big Beautiful Bill Act, or OBBB for short, and it has completely rewritten the rulebook, especially when it comes to corporate deductions. This is creating a massive domino effect all across the country. So this puts every single state in a tough spot. They have a big question to answer. Do we conform to these new federal rules, or do we decouple and kind of go our own way? Let's break down what that really means. Okay, so this whole idea of decoupling, it's absolutely crucial to understand. It is basically a state's way of looking at Washington and saying, you know what, thanks, but no thanks. It's this power that lets them protect their own state budgets or, maybe create a better environment for their local industries, even if it means totally bucking the federal trend. And right here, you can see that divide playing out in real time. You've got states like Delaware, D.C., and Michigan. They're all choosing to decouple from federal rules on stuff like bonus depreciation. That's the rule that lets businesses write off big purchases really fast. They're basically saying, hey, these new federal freebies just don't work for our state's budget. But then, on the flip side, you've got West Virginia, and they're looking to conform. They're probably seeing a chance to lure in new businesses by matching those exact same federal tax breaks. And that brings us to our next big point. States aren't just sitting back and reacting to what the federal government does. Nope. They're getting proactive. They're completely rewriting their own playbooks, especially for how they tax companies that do business in more than one state. And a perfect, and I mean perfect example of this is going down in Illinois right now. But before we can really get what Illinois is doing, we have to talk about this concept called apportionment. Just think of it like this. A company makes a ton of money all over the country. That's the pie. Apportionment is just the method states use to figure out how big of a slice of that pie they get to tax. And believe me, the specific method a state chooses can make a huge difference in a company's final tax bill. So here's the deal in Illinois. They're switching from something called the Joyce method to the Finnegan method. Now, here is the crucial takeaway, the thing you have to remember. Under this new Finnegan rule, if just one single part of a big corporate family has a presence in Illinois, then all the sales made by the entire company into Illinois get counted for tax purposes. It's a massive shift, and it's pretty clearly designed to capture a lot more tax money from those big, sprawling corporations. And listen, this isn't some theoretical thing happening way down the road. This change is effective for tax years ending on or after December 31st, 2025. I mean, that's right around the corner. It's going to completely change the math for so many large companies in Illinois, and you better believe they're scrambling to prepare for it right now. Okay, let's shift gears a bit. Now we're going to look at how tax policy is basically in a foot race with technology. And frankly, it's losing. This is where things get super modern, right? States are desperately trying to figure out how to apply tax rules written decades ago to things like crypto, social media, and AI. Take Chicago, for example. They've rolled out a new social media amusement tax. And get this, it targets companies that collect data on more than 100,000 people in the city. It's a really creative and kind of controversial attempt to tax the value that's being created from all our data right there within the city. Meanwhile, down in Tennessee, they're actually bringing some much-needed clarity to the world of crypto. They've officially ruled that crypto is intangible property, like a stock or a bond. So what does that mean? It means the money you make from selling crypto at one of those crypto ATMs, it's not subject to the state's main business tax. And that, my friends, is a huge win for anyone operating in the crypto space in Tennessee. Illinois is also stepping up, this time with some guidance on generative AI. They've basically said that if you're providing an AI service through the cloud and the user isn't downloading any software, then it's a service. And services generally aren't subject to sales tax. That little distinction between a service and a sale of property is absolutely critical for the entire booming AI industry. And for something a little different, but, super practical, Florida is getting ready for a world without pennies. The government stopped making them. So the state has clarified that, yes, businesses can round the final cash total up or down. But, and this is the important part, the sales tax has to be calculated on the exact price before you round. It sounds like a tiny detail, but it's one that every single business taking cash in Florida has to get right. Of course, none of these new rules and taxes just happen. They all get challenged. And the final battleground? It's almost always the courtroom. And the decisions coming out right now are setting some major precedents that are going to ripple out for years and years. A perfect example of this just came out of the Ohio Supreme Court. The court ruled that a company had to pay tax on goods that were just delivered to a warehouse in Ohio, even though those same goods were later shipped out of the state. And their reasoning was really powerful. They basically said, hey, our Ohio roads and our infrastructure, they made that initial delivery possible, so Ohio gets a piece of the action. It's a huge reinforcement of a state's power to tax any economic activity that touches its borders. And it's definitely not just Ohio. I mean, these major legal battles are flaring up all over the country. There's a case in New Jersey that's actually aiming for the U.S. Supreme Court, questioning if a state's rules are even constitutional. Over in Pennsylvania, a court just limited the damage from a previous ruling by saying, nope, no massive retroactive tax refunds for you. Every single one of these cases is shaping the future of state tax law as we speak. So what's the takeaway from all this? The big picture is that the U.S. state tax system isn't really one system at all. It's more complex and more fragmented than it's ever been. That big federal OBBB law was like a stone thrown into a pond, and now we're just watching all the ripples spread out, creating this crazy patchwork of different rules. For any business that operates in more than one state, well, it means you have to be constantly on your toes just to stay compliant. But it also creates some really interesting opportunities to strategically plan and maybe, just maybe, lower your overall tax bill. And that leaves us with one last really big question to think about. We live in a world of AI, of digital assets, of a borderless internet where the old definitions of a sale or doing business are just totally breaking down. So what's next? What new, currently untaxed piece of our digital economy is going to be the next big target for state tax collectors? That's something to chew on. And that's it for this edition of The Explainer.